Hey future millionaires, this is Phil from Next Chapter Financial Solutions and Services. In this video, we're going to show you all about ETFs. I'm going to give you a detailed overview, and then at the end, I'm going to give you an example of how you could turn an account that had $0 at the very beginning and 5 years later have around $50,000. Now again, this is just informative, but it's really meant to inspire you because we believe at Next Chapter that everyday people can build wealth. We just got to arm ourselves with the right information, the right tools, and the best practices to get there. So I know you can do it, and I want to show you the art of the possible in this video. So what exactly is an ETF? An ETF is an exchange-traded fund, and there are many types. We're going to go through that, and also we're going to go through how to buy them. So an ETF is an exchange-traded fund, which basically means it's a basket or a group, in more layman's terms, of securities, which is stocks and other such items that trade on an exchange. And ETFs prices change throughout the day. They go up and down, just like the stock market does. It goes up and down. Because they're all securities, and the way that they're fashioned to track these securities that are within the actual ETF, that's why the prices go up and down throughout the day. So as demand goes up for the ETF and then the items in the ETF, the price goes up. If the demand goes down for some reason, there's a big sell-off in one of the big holdings within it, the price will go down. And so that's why ETFs are so interesting. And because it's all electronically, that's why it says it's an electronic exchange-traded fund, that's why there's going to be some lower fees. Now, what's made up of an ETF? ETF can be made up of stocks, commodities, bonds, both U.S. and international. So it's a great way to diversify your portfolio pretty quickly with just a few different baskets of a few different actual ETFs. And again, because it's primarily electronic, your fee structure is going to be lower than buying individual stocks. And again, that depends on the broker you use. So it's important to recognize exactly what you're walking into. But we're going to go over some of that for you to help you understand and get the good basis of understanding of what to do when you go forward. There are so many types of ETFs. There are at least eight types of commonly categorized ETFs. You've got passive and active ETFs, which basically means that's the level of tracking and management of the ETFs. Passive ones are very passive. They usually follow some level of index. So like one that follows completely the S&P 500. Active, where you have an actual professional trying to actively manage the fund and make moves according to what they believe economically will occur with that sector of securities that they're looking for. Bonds, as they say, is just bonds. It's an ETF full of bond funds or bonds. And then stock ETFs is just purely stock-based ETFs. Then you can have industrial and sector ETFs. So, for example, you can have one for just natural fuel versus one that is for utilities versus one that's all for technology. Commodity ETFs are going to be ones based off commodities. What are commodities? Gold, precious metals, and other such things like natural gas, sometimes is referred to as commodities. Currency ones will track a currency that could be the US dollar, the other international currencies. An inverse ETF is actually exactly what it says. It basically says we're tracking to do better when an inverse of what it's tracking against. So if the Dow goes up, the Dow Industrial Average goes up, then the ETF will go down. But it's hoping that it goes down enough that it could shoot up, and that's an opportunity to buy, make more money on that ETF. And then leveraged ETFs usually track some form of security or some group of securities and try to do just a little better. That's why they could leverage it. So like it'll track like a Tesla, for example. In fact, I'll do a video on one that does track Tesla. And then from there, it also tries to go just 1% higher. So how exactly do you buy ETFs? Well, a quick 4-step process to determining how you're going to buy an ETF is first, determine what type of account you're going to buy it in. Is it going to be an IRA or a brokerage account? An IRA, which is an individual retirement account. A brokerage account is just a regular taxable account. Why do I list these two options? Because commonly ETFs are not available in 401k plans. It is possible, so your employer might have them, but not all of them do. Okay, so next from there, you decide which broker you're going to work with, and we're going to go over a quick list of brokers in the next section, and some factors on how to determine which broker you should consider using. And then from there, you decide how frequently you're going to invest. Weekly, bi-weekly, monthly. I guess in a way you could do daily too. That'd be a heck of a thing to set up. But still, you just want to do this to keep in the habit. It's these small hits every week, every month, every 2 weeks into your investments will help you stay disciplined and build wealth over the long term. Okay? Then from there, to make it these small hits easy and make it a good habit, you want to set it up to be an automatic transfer out of your bank account, and then further an automatic purchase within the investment broker. If you do these things, you make it automatic, and you build a budget that could support these automatic transfers and transactions, you'll be surprised what you can do over a short period of time. Some of the standards, why we list them, because, well, frankly, they're some of the best ones out there, as well as they're very low in cost, and they have good tools. So you have Fidelity, Webull, M1 Finance, Charles Schwab, E-Trade, TD Ameritrade, TIAA Craft, and Vanguard. These are some great options. These are just examples. Do your own research, determine who's going to be best to meet your needs. And while you're doing your research, here's some things to keep in mind. Look for a basic understanding of the trading fees. You want your trading fees to be as low as possible, if not zero. In addition to that, you want the opportunity to do fractional shares. Why? Real simple. You can have a great ETF that is doing great, has been doing great for years, and you still believe in it, and you believe it's going to do great for years to come. It might be $500, and you might only have $400 to invest when you first start the account. So you want an opportunity to buy $400 of that currently $500 share. Then from there, you want to have good tools. That will include screeners, which will help you narrow down ETFs pretty quickly, so then you can figure out from there, you go deeper and do your risk analysis from that screening to figure out if this is the ETF for you. Then you'll do ratings, and then from the education, and then finally reports and research. It's really important to do your own research independently and know what you're looking for. Look for a good track record. Well, although past performance does not indicate future performance, it's a good indicator of the art of the possible, what could happen here. Now we're going to take the opportunity to go over some popular ETFs. There are so many out there, I cannot possibly cover them all in one video. In fact, I think it would take me over 24 hours to cover them all, and just can't pull it off in 15 minutes or less. Okay, so your first one is SPDR. SPDR, or SPY. The SPDR is a index one that tracks the S&P 500. It is the oldest ETF in the U.S. There's one that started before the SPDR, I believe is a Toronto-based ETF. Next, you have the IWM. This is an iShares Russell 2000 Index. This tracks the Russell 2000 Small Cap Index. Now, what is the Small Cap Index? Small cap means small companies, smaller new companies usually. Mid cap will be middle-sized company. Large caps are big companies. Large caps are examples like Apple. All right. So these are great opportunities. Next, let's go into another one. This is a great one. Triple Q. Invesco's Triple Q tracks the NASDAQ 100 index, which typically contains lots of technology stocks. Finally, on our small list for today will be DIA, also referred to as Diamonds. This is the SPDR Dow Jones Industrial Average DIA Fund, which represents 30 stocks of the Dow Industrial Average. And this one is just narrowed down to 30 stocks. But it tracks these 30 stocks and does really well. And these are low-cost ones. Now, I warned you guys, we're going to go deep. But you need to go this deep to start getting some understanding of the art of the possible. So, let's take a look, right? So, as of June 30th, 2023, the one-year return on this one, the SPY, was 19.46. 3-year was 14.47. 5-year, 12.16. And then finally, the 10-year was 12.72. These are some great returns. And the indexes, this also displays the indexes which it was trying to track against. You can see these numbers are super close. And that's what the goal of this fund is to be really within as close as possible to the index in which it's tracking against. Finally, another aspect to look at on this video, we're going to cover some of its holdings. Its top holdings: Apple, Microsoft, Amazon, Nvidia, that's a chip manufacturer, Alphabet, which is the parent company of Google, Tesla, Meta, as some of you may know, Meta is actually Facebook. That's the parent company of Facebook. Alphabet, again, that's another Google, so it's Class A, Class C, so it's a different grouping of stocks. And then finally, Berkshire Hathaway Class B. I should do a video on this because Class B is the less expensive version of Berkshire Hathaway. Class A is like a lot of money. Then finally, United Healthcare Group Incorporated. You see they diversify, so it's not just tech stocks on big companies. Next up, we've got Triple Q. Triple Q, let's look at their returns as of June 30th. You've got the 1 year 32.87, 3 year 15.01, and 5 year of 17.3. Again, these are averages for the year. So if you blended all the 5 years, on average, your investment would have grown by 17.43. And then finally, the 10 year was 18.97. And again, they show you their underlying index. Look at that. Real close, real close. Real close, real close, real close. They're doing their job. They're trying to be within their index. And then from there, they're also trying to beat their benchmark. And they'll show you their benchmarks too. So much information just at your fingertips. Just a little research and you can do a whole lot. Now, what's in Triple Q? Microsoft, Apple, Nvidia, Amazon, Tesla, Meta, Class A, Alphabet, Class A and Class C. These are, again, Google, Broadcom, which is a communications company, and then PepsiCo. And this one gives you a good breakdown of what are actual groups as an overall. Look at their sectors. You got technology, consumer discretionary, healthcare, telecommunication, industrials, consumer staples, utilities, energy, real estate, and basic materials. This is a great way to get a lot of details and a lot of information and broad investing, not just one specific stock. Because many of us just don't have the time to track all those stocks. So in the next section, we're going to go over what if you only bought SPY and Triple Q for 5 years. What would the returns be? You'd be surprised. It's a big number. Okay, so right now the current max IRA contribution is $6,500. So let's say you did $6,500, or at least you could do $6,500 in your IRA, whether it be traditional or Roth, for 5 years. And again, recapping the returns, you get your 1 year, your 3 year, your 5 year, and your 10 year. What would this be in 5 years? In 5 years, it would be $50,000. How would that be broken down? It would be roughly $32,000, or 65% of that $50,000 would be just your contributions, and the rest would be growth. So around a little close to $18,000 would be just growth. Now, let's look at this further. Let's just say you're in it and you said, I'm going to keep doing this. I'm going to keep contributing. What would it be in 10 years? I think you're going to be surprised. Roughly $162,000. Now, let's look at that breakdown. You'd have about $65,000 in actual contributions, and then the rest would be growth. So 40% would be growth, 40% would be your investment, and 60% would be growth. Pretty amazing. So let's wrap this up. ETFs, or exchange traded funds, present a great opportunity to invest and build wealth. If you like the video, please like, subscribe, and share. Also, check out the link below for our Etsy page, where you can find this template if you like it, and some other money-saving tools. More reviews and deep dives to come. Also, we have a link to a mutual fund video, because you need to know about mutual funds as well as ETFs if you're going to be building wealth. Again, mutual funds are usually in your 401ks, and ETFs are available basically everywhere else. Talk to you soon, and thank you from the Next Chapter team.